Hello and good afternoon, everyone. I want to welcome you all to our webinar, Spotting Transfer Pricing Red Flags in Financial Statements, a guide for statutory auditors. My name is Camille, and I am your moderator for today. And before I introduce our speaker, I'd like to take a moment to briefly share some information about our company, InCorp Global. We are the leading one-stop corporate solutions provider and business advisory group in the Asia Pacific region for corporate incorporation, corporate secretarial support, taxation, accounting, compliance, and risk assurance services. Now, for more information, please visit our website at www.incorp.asia. Now, just a few housekeeping notes before we get started. If you have any questions for the speaker, please submit them anytime during the webinar by clicking on the Q&A button at the bottom of your screen. After the presentation, we will have a Q&A portion which will last around 10 minutes where our speaker can answer your questions. Now, we do apologize in advance if we cannot answer all of your questions due to some time constraints. In the event of any technical issues during the session, we seek your kind understanding and please bear with us while we rectify the problem. Okay? Lastly, we will also record this session and share the recording with all of the participants in due course. Now, let me introduce our speaker for today, Mr. Nipun Arora. He is a director at InCorp Singapore, leading the transfer pricing practice. With over 20 years of experience, primarily with the Big Four accounting firms, he advises SMEs and multinationals across industries such as automotive, retail, telecom, FMCG, and luxury goods on various transfer pricing matters, including documentation, due diligence, litigation, and tax-efficient structuring. Now, without further ado, let's welcome Nipun to kickstart our webinar. Thank you all. Heading over to you, Nipun.
Good afternoon, this is Nipun, and I'll be taking you through this TP journey for the next half an hour or so, and I hope it'll be beneficial for everyone on this group. To determine and assess the pricing between related entities, so whether it's domestic or overseas related parties, TP rules still apply as far as related party transactions are concerned. So this is just an overview of what is TP. So it is pricing of transactions that are undertaken between related parties, domestic and cross-border, both covered and applicable for all type of transactions between the related entities. Now, this could be goods, services, IP transfers, intercompany loans, intra-group services, cost allocation. So all transactions that occur between the related entities are covered under these TP regulations, and the pricing methodology has to be determined on an arm's length basis. Now, arm's length basis means that the transactions are to be priced in such a way that had the transactions been undertaken between two unrelated entities in an open market scenario, what would have been the pricing? So TP ensures that the pricing between related parties is mirrored in a way that they are unrelated and the pricing is based on market scenario, market economic conditions, rather than any tax planning or any other way which will result in profit shifting. So this is the basic genesis for introduction of TP rules worldwide to avoid profit shifting and to avoid any tax-based erosion wherein the transactions take place. Okay, so next concept that we do is on the related party. Now, what is a related party? In simple terms, two parties are related when one party has a direct or indirect control over the other party. It could be a direct control, like a parent and a subsidiary. Indirect control, wherein parent, then one subsidiary, then has another step-down subsidiary. So where one party has the ability to control, influence decisions of the other entity, has significant influence or voting power. So all of these factors lead to control of one entity over the other entity. So then in that scenario, the entities will become related entities. Control is not directly defined anywhere. It is based on the conduct of the parties that we assess whether there is control. But yeah, primarily, if it's a wholly owned subsidiary or a majority shareholders or common directors between entities, we say that the control exists unless and until it is proved to the contrary that there is no control. Prima facie, it will be assumed that there is control and the entities will be related. So all transactions will be considered as related party transactions. So these are the common sources to identify related party transactions, like notes to financial statements. FRS 24 requires disclosure of all material related party transactions. group chart. So when we do the audits and all, we do take these kind of documents like group structures, group shareholding structures, board minutes, management reports. So all of these documents are the first point, wherein we come to know about what the org structure is, what is the internal department structure, reporting structure, what could be the potential related party arrangements between the local entity and the overseas entity or other domestic entities. So these are the first points to make sure that we start identifying related party transactions, then internal contracts, past TP files, TP policies, interco agreement, past benchmarking reports. All of these are really important to assess and analyze to understand what the related party arrangements exist at the current point in time, and how the company has been following those TP policies and whether these have been consistently followed. Now, there are certain could be situation of unexplained intergroup transactions like undeclared services or capital flows or income shifting. These are really important to be assessed because all RPTs have to be reported, and therefore, if the auditors come across any unexplained intergroup transactions, these are clearly high risk areas which need to be assessed, and documentation has to be available to make sure that the basis or the genesis of these transactions is truly accounted for, and then hence they are reported in the related party schedule. These are some of the key risk areas that as an auditor we need to focus while we are undertaking audits. So when we have identified the related party transactions, we need to be sure that the underlying documentation is also in place. So say, for example, first and foremost is the interco agreement. Even the tax authorities, when they do the TP audits, they ask for interco agreements and the underlying documents, which is the TP policy or any other document like board minutes or minutes of meeting, wherein these transactions have been authorized and the policies have been agreed between the related parties. So these are the first few documents like interco agreements and minutes of meeting that are to be analyzed. Then further drilling down to the respective transactions such as interco services, like you may have come across a lot of these common transactions like in management fee or business support services or cost allocations or royalties. And also these are important transactions which are very generally taking place between entities, but the entities don't have much of a background documentation to justify the pricing or to justify the benefit test. Like the service recipient has to get a benefit out of these services. That is why the entity ends up paying to the related party, because if there is lack of economic rationale or there is no justification for the service recipient to receive those services, the tax authorities will simply disallow that transaction, saying that this is shifting of profits from one jurisdiction to another. So for services transaction, it's important to analyze whether the service recipient is actually needing those services and is actually benefiting from those services. Otherwise, the rationale for payment is not justified. Similarly, for loss-making entities, it becomes really imperative to understand whether that is as a result of related party arrangements or regarding unrelated party transactions. Because tax authorities lay very clear focus on loss-making entities, and if they have large RPTs, the related party transactions, because generally tax authorities allege that losses may be attributable to related party arrangements. In that case, they expect that each and every related party transaction has to be analyzed and benchmarked on an individual basis rather than testing the net margin as a whole. There may be some transactions which have a very low pricing or nil pricing between related entities. This could be a potential undercharging or overcharging. Now in cost plus entities, generally, wherein cost plus arrangements are there between related parties, some of the cost base may be compromised. So in that case, the cost base needs to be assessed because the fully loaded cost base needs to be considered. Otherwise, the service provider is underreporting the revenue. So cost plus entities are really important to be assessed as far as the fully loaded cost base is concerned. Another situation could be in related party arrangements is analysis of the pricing. Now, a lot of transactions are priced without any justification or basis. This is a high risk area because tax authorities will also ask us like the basis of pricing, because any price that we have between the related parties, say for example, the service provider is providing services at say cost plus 12%. Now, tax authorities will be very interested to know how this 12% is arrived. What is the basis of arriving? Do we have a benchmarking analysis? Do we have a report to justify this 12% markup? Keeping in view the kind of services, is it really in line with that value addition that is done? Or does the kind of services are such that they command a higher markup? So the benchmarking analysis or the past TP documentations become really important to justify or analyze whether the pricing carries a basis and carries a justification. Otherwise, simply stating in the agreement that we are going to operate at cost plus X percentage may not be sufficient to prove that it is an arm's length price. Then there could be certain complex structures within these group entities like interest-free loans. Now, interest-free loans has been a very contentious issue in the past also, and now with IRAS making it really clear that even the these loans have to be benchmarked effective Jan this year. So in those loans which are interest-free may not be considered as on an arm's length basis unless and until there is a very valid justification that two unrelated parties also could have entered into a similar arrangement resulting in an interest-free loan. But if that is not possible, or if that kind of a situation doesn't exist, then the tax authorities generally will treat it as not at arm's length if it is interest-free. Because generally any lender will charge interest from the borrower, irrespective, like if any unrelated party arrangements were there, lender will definitely charge interest. So in these kind of transactions, specifically like the services transactions, royalty transactions, management fee transactions, finance transactions like loans, it is important to analyze the backup documentation and to assess whether all of these pricing policies justified are all substantiated by backup documentation. It is imperative for us when we clear those transactions while doing audits or while we report those transactions, we ourselves are also satisfied that these have been priced as per proper benchmarking analysis.
Okay, good. Nipun, you can continue.
Yeah. So these are some of the other areas that we need to focus on. The services charged, as I said, need to demonstrate a benefit. Lack of functional analysis with actual roles performed. This is important because characterization is really critical when we analyze the related party transactions. So for example, suppose there is a manufacturing entity and there is a distribution entity. Now, the distribution entity will place orders with the manufacturing entity to do the manufacturing of products. Now, depending on the functions, risks, and assets utilized, the manufacturer can be a full scope manufacturer or a contract manufacturer with low risk profiling. Whereas the distributor can be a full risk distributor just managing the trading of those products. On the contrary, if the distribution entity is a low risk entity and all decisions are taken by, say, for example, the manufacturing entity on what products to manufacture, how much to be sold, what would be the sales targets and all, then the distributor becomes a low risk distributor, and then the profitability of that entity will be on a lower side rather than on a higher side, because low risk, low return kind of a concept. So in that case, characterization of the entities becomes important, whether it's a full grade manufacturer or a contract manufacturer or a full risk service provider or a full risk distributor. So in that case, the characterization and the returns have to be commensurate. Next, possibility that other transactions could be head office charges. Now, in some cases, head office expenses are allocated to multiple subsidiaries without jurisdiction in various jurisdictions. And then this head office cost allocation has to be justified with some basis, because the shareholder expenses, like generally the head offices will do consolidation, audits, managing financing arrangements for the group as a whole. Now, these kind of transactions, which they do for the group as a whole for the benefit of the group, are not supposed to be recharged to the group entities. They have to be absorbed within the head office only. So these kind of transactions have to be analyzed to make sure that the shareholder services are not recharged to the group entities, because then that is against the TP principles, because the subsidiaries do not request for these services. These are for the group as a whole, and subsidiaries should not be recharged with those transactions which are shareholder services. Similarly, royalty payouts and all, when based on local market or brand value, I mean, like these again as a percentage of sales have to be really analyzed to see that the sales that are being undertaken are really benefiting or are as a result of the intellectual property embedded in the product or the brand. So this is important to assess, because excessive royalty payouts by the local entities, again, the tax authority challenges are higher, because tax authority generally will disallow these royalty payments if they perceive these to be very excessive, and when they see that it is not commensurate with the benefit that the local entity is getting from that IP. So in that case, the royalty payouts, head office charges, management fee, these transactions need to be justified or analyzed through a separate TP documentation or analysis so that we as auditors are satisfied that these transactions are on an arm's length basis and are compliant as far as the underlying documentation is concerned. The other key area that we should focus is sudden shifts in profitability year on year. So when we do the trend analysis from one year to another year, if we see huge variations in some expense items or some related party arrangements or some profitability arrangements, that should be questioned because those could be as a result of change in TP policies, which may not be supported by a documentation. So in that case, these kind of analysis on RPTs from year to year or from say past 2 years to the current year will really give us some cue about the change in profitability, change in product profiling, or change in the number of related parties with whom we have transacted in the past. So this trend analysis will also give us a lot of cue and a lot of questions to be asked to the companies for their TP policies and TP documentation. So these are some of the responsibilities that during audits that we need to be really considerate about the nature and scope of RPTs, completeness of the disclosures, request and review of documentation. Now, TP documentation as per the Singapore TP regulations is mandatory under Section 34F. Now, as per this section, every entity which has a turnover gross revenue of 10 million is required to have a TP documentation in place. And this is not required every year. This is to be done once in 3 years, if there are no changes in the transactions or if no changes in the TP policies. So as auditors, we need to be sure that the entity is maintaining documentation if at all there are related party arrangements, and if they cross the threshold, it is mandatory to have one. And otherwise, simple benchmarking analysis to justify the interco pricing will be sufficient if the turnover doesn't cross 10 million. So these are documents which are mandated by law and have to be prepared and assessed by the auditors to make sure that the opinion that is given is true and fair. So again, this will have impact on tax provisioning or deferred tax accounting, because if there are very high risk areas or sometimes we perceive that the transaction that has been undertaken lacks justification. Some entities in my experience have even created contingent liabilities or have even created provisioning for that transactions also if they perceive it that it is a very high risk transaction and there is a high probability of tax authorities doing a negative adjustment on those transactions. So in that case, it is very important to decide, or based on the documentations prepared by the company, whether the risk is high, low, or a medium in that case. And then all the intergroup transactions that are recurring or one-off have to be segregated to make sure that these one-off intergroup transactions are not very material to impact profitability, or they are not like very high-risk transactions undertaken in 1 year but may not be there in other years, because then that for that particular year the risk of audit becomes very high, because when the tax authorities are selecting cases, they also analyze these RPTs based on the RPT form that is filed with the tax return. And they also utilize it for assessing the risk that they perceive in these transactions and then send out notices for audits. So that's the rationale why RPT form is filed along with the tax return, so that tax authorities can do their own risk analysis regarding these related party transactions. Yeah, these are some of the other aspects that need to be taken care of, like if TP policy has been consistently applied or it is changing year on year, because generally IRAS also suggests that if benchmarking analysis is done, it is valid for 3 years. It has to be refreshed and redone after 3 years. So if there is no change in the transaction, if there is no change in the risk profiling, the same benchmarking is valid for 3 years. But if the turnover crosses 10 million, then yes, the mandatory TP documentation will kick in, and that has to be undertaken irrespective of whether the benchmarking was done in the past year or not. So if the turnover crosses 10 million and the value of related party transactions also crosses that respective thresholds which are there in the guidelines, then it is mandatory to have a TP documentation. The other aspect is on the basis of charge that the companies follow. So it is very important for the auditors, for us to discuss with the management to see if cost allocation methods are reasonable, are consistently followed, accounting principles are followed for cost allocation, because generally the policy followed is operating cost plus margins. So what is classified as operating, what is classified as non-operating really has to be carefully assessed, because otherwise it could lead to overcharging or undercharging to the related party. So this is more important for transactions wherein the entity is a service provider and charges on operating cost plus markup basis. So that operating cost base has to be defined so that the management is clear what is operating cost, what all items to be included under operating cost. These are some of the case examples based on practical experience that we generally see as far as related party arrangements are concerned. Intergroup services without agreement or benefit test, Related party loans, which are interest-free, and if it is interest-free, TP documentation exists, but it is not really complete, or it is not aligned with operations, or it doesn't cover all the related party arrangements, specifically where there are one-off transactions, related party arrangements, and they are significant transactions. It is important to have a basis for that transaction also. Wherever there are group TP policies, like for royalties or management fee, those need to be available and assessed properly so that it is ensured that all group entities are following the same group TP policy, and there is a centralized documentation prepared. Some of the other jurisdictions have this concept of master files. So if there is a local file and a master file already prepared for other jurisdictions, we can ask for that, those files, to ensure that all RPTs are covered and justified. All the cross-border support service fee, again, has to be justified through documents, through proper invoicing, through interco agreements, and has to be substantiated through day-to-day, say, work orders or statement of work. So those kind of documents are really imperative to have to justify the existence of the related party transaction, because substance is important in these kind of situations. Another example could be like the central procurement hubs that are created. Normally, there's a central entity which procures for the multiple group entities. Now, what pricing they need to recharge to the group entities when they procure and resell, again, is important, because the controlling functions and the controlling risks undertaken or assumed by the centralized procurement entity have to be assessed to manage their returns. So these are some of the examples, like which common transactions which we come across for multiple entities, and these all require proper backups to be there for justifying the pricing and justifying the actual existence of the transactions. These are some of the best practices that can be followed while assessing the related party transactions, like completeness of RPT disclosures. Like all RPTs to be disclosed based on FRS 24 after cross-checking with the GL, board minutes, tax disclosures, to ensure that all transactions are properly recorded, the amounts are correctly recorded, because generally for RPT forms and RPT arrangements which are filed with tax returns, the IRAS will also verify with that disclosure in the FS, and if there is any discrepancy, they will later on ask. We've seen they have asked us to reconcile the numbers in the RPT form versus FS. So that disclosure becomes really important, and correct figures are reported. Documentation of interco agreements, again, is important to justify the actual substance of the transaction. Economic substance of recharges, the intergroup transactions, specifically the management fee, although that the actual entity which is receiving the services is benefiting, and these are not shareholder services or duplicative services. So if the service recipient is already having internal department, internal employees who are rendering services, and then the head office is also providing same services, then these become duplicative. Tax authorities will straight away disallow those duplicative services. And then TP documentation is important based on Section 34F, because it's mandatory to have that documentation in place. The most important thing here is when IRAS issues a notice to file TP documentation, it has to be filed within 30 days. Beyond that, and taking extension and all will always suggest that the documentation was never in place, and it is being prepared now. Another important aspect on TP documentation is that it is to be dated. So it has to be dated before the tax return is filed. So dating of the documentation is mandatory. Even if it is an updated one for the second or a third year, it still has to be dated. That's why tax authorities encourage that the TP documentation is in place and prepared before the tax return is filed, and it is properly dated, so that whenever there is a notice issued, it can be filed within 30 days. Now, 30 days is really sufficient time. There are jurisdictions like Malaysia or India and other jurisdictions that give only 10 days or 14 days to file. Now, their rationale for keeping such a less number of days is that entities don't start preparing documentation only on receiving notices. Because the law says it has to be prepared beforehand, so it is suggested, and it's mandatory to have TP documentation if it's applicable, and prepare before the tax return is filed. So these are some of the important documents which all entities with cross-border or domestic related party transactions should assess. If they don't have TP documentation because of lower thresholds, it is still advised to have a TP policy memo in place, which will list out what are the intergroup transactions, what are the TP policies being followed, and how the group entities are adhering to those policies. Some kind of document to justify the existence of related party transactions and their basis becomes important, even for governance purposes as well as audit purposes. Some of the other best practices is like to assess the reasonableness of markups, pricing models, encourage management to revisit TP positions annually, because there may be changes in the functions, or there may be changes in the risk profiling, which may prompt a review of the existing TP policies if there have been certain changes, say some policy changes, economic policy changes, which impact the supply chain or which impact the pricing of the related party transactions. So these need to be assessed on an annual basis. This may or may not result in revisiting the pricing, but yeah, at least we'll be sure that if at all the pricing needs to be revised, that is taken upfront, and when the next financial year begins, the new pricing policy can be adopted. Internal control procedures are important in this case because recording of related party transactions is really critical, because this falls under operational TP, wherein all RPTs need to be recorded accurately, and when these are reported, these should be clearly available from the internal accounting records or RPT tracking tools. Some of the organizations have separate tools, wherein they will input only the related party transactions where the volume is very, very large, and therefore RPT tracking tools become very important in that case. Wherever there are complex TP arrangements, or where there are arrangements where, say, for example, the auditors are unable to take a call, I've seen in my experience, they would engage experts in that case to have their opinions on the related party transactions. And if they have a fair opinion from these specialists, the auditors, again, are easy for them to go ahead and conclude the audits without any negative opinion. So these are some of the best practices which have been followed and which are suggested to be followed while undertaking statutory audits, because again, the responsibility lies on the management and us together to make sure that no such transaction is reported which has no basis or which has no underlying genesis for us to prove. These are some of the potential questions here, which can be asked when we do audits, like how to identify related parties, nature and extent of related party transactions. What is the documentation in place? Has the company prepared TP documentation in the past? Are the thresholds met? What is can the local file be available? Or if the other jurisdiction has prepared master files, can that be available? Because certain jurisdictions have local file and master file concept. So we can ask for those documents, which will give us some kind of level of satisfaction that these policies are operating at the group level and are consistently followed. And how the arm's length principle has been applied, what are the markup on costs for intergroup services. IRAS also recommends a 5% markup, again, for low value add services. In that case, there is no documentation required, because if our support services are low value add, IRAS says that you can go ahead and apply a 5% markup in that case. For financial statements, again, if any TP adjustments have been recorded, see, voluntary TP adjustments are also allowed. So at the end of the year, if the management is of the opinion that the TP policy is not followed or has not been consistently followed throughout the year, they may do or recommend a TP adjustment, which is called a voluntary TP adjustment in the books. Now that is routed through the books before the books are closed and the audits are finalized. Voluntary adjustments are allowed to be made in the books, so that the RPTs, the related party arrangements, at the end of the year, conform to the arm's length arrangement. There are certain aspects that need to be taken care of while doing voluntary TP adjustments, like what is the basis, for how many years we are making those adjustments, whether that leads to any further surcharge or not. So these are a few factors that need to be considered. But yes, if it is perceived that the TP policy is not followed, voluntary adjustment can be done before the books are closed. Intercompany balances need to be reconciled at the year end. Again, important aspect here is if the interco balance, say for a receivable kind of a balance, it is outstanding for a long time, generally the tax authorities will convert or treat as a deemed loan and then say deem an interest on that. So if there is a receivable lying in my books from a related party for 5 years or 6 years, I can't continue to show it as a routine trade receivable. The tax authorities will immediately classify that as a long-term loan and start deeming interest on that. So it is better to reconcile the interco balances and settle out also as early as possible to avoid being classified as long-term loans. Disclosures and compliances, again, are important. Have all the RPTs being disclosed in the notes to accounts, have RPT forms being submitted along with tax return, documentation has been filed with IRAS. Say, for example, if IRAS had sent a notice, was it filed within 30 days? Are there transactions with related parties in low tax jurisdictions or tax havens? Because these are the transactions which the IRAS or other tax authorities will definitely focus on with low tax jurisdictions or zero tax jurisdictions. Then IP transfers, like if there have been transfer of intellectual property within entities, valuation is done, there are valuation reports available, because for IP transfers, valuation becomes really important. So valuation reports have to be there. Disputes, if any ongoing with IRAS regarding the past years, are taken into account. If any contingency or provisioning has to be done for the past year's disputes, those need to be taken care of, because if any disputes are perceived as very high risk or will eventually lead to an adjustment, then we need to be prepared for that right now. And documentation and audit evidence is really important, because clear internal controls regarding flow of documentation within the entity, procedures over pricing, approval of related party transactions, again from governance viewpoint, are really critical for functioning of the entity from tax authority challenge as well as audit viewpoint.
Thank you so much, Nipun, for your valuable insights in spotting transfer pricing red flags in financial statements. Now, we have about a few minutes for the question and answer portion. So please feel free to type in your questions by clicking on the Q&A icon at the bottom of your screen. Then Nipun will then address them accordingly. Okay, so while we are waiting for the questions to come in, I'd like to remind everyone again that we are recording this webinar session and we will ensure to share it with you in due course. If you have any other questions regarding some of the other service offerings that InCorp is offering, please feel free to visit our website at www.incorp.asia. Okay, we actually have a few questions that we received from the registration form. So I'll probably ask a few of these questions to you, Nipun, and you can just answer. So we have this: why is transfer pricing considered one of the risk areas for multinational groups? And what makes it a key focus during tax audit?
So this is important because TP is critical risk area, because it directly impacts how profits are allocated among jurisdictions. So if the multinational group is operating in various jurisdictions, we'll always be prompted to price our transactions in such a way that the profitability is in a low tax jurisdiction, and with differing tax rates, authorities are also very keen to ensure that taxable profits are not shifted to lower tax jurisdictions. So every tax authority wants their pie of the tax that they are expecting from the entities operating within the jurisdiction. So that's why for each jurisdiction, adhering to the arm's length pricing is really important to avoid any adjustments, because any adjustment in one jurisdiction will impact the other jurisdiction also. So that is why it is becoming a very key critical area for multinationals. And now with OECD coming up with Pillar 1, Pillar 2 guidelines, it will be more important for entities to follow TP guidelines and regulations on a consistent basis.
Okay, we have another question from Thai Maggie. Non-fully compliance of TP documentation, will it suggest to qualified auditor opinion?
See, if you perceive that the transaction has other underlying documents in place, like interco agreements are in place, there is basis approval in place, minutes of board meeting is there, authorizations are in place, and TP documentation still has the time limit to prepare, like the deadline is next year, November, for a particular year.
Okay, well, we're still waiting for some of the questions to come in. I'll read another one from the registration from before. Okay, what are the common transfer pricing risk indicators that auditors or tax authorities look for when reviewing related party transactions?
So auditors or tax authorities, when we are assessing the related party arrangements, the key risk areas, again, on the basis of which tax authorities also select cases, is like recurring losses, significant transactions with minimal documentation, low transactions with low tax jurisdictions, or a very large amount of management fee or royalty without clear benefits, inconsistency in the related party policies which are being followed, so and unexplained fluctuations. These are the key risk areas which the tax authorities generally assess when they select cases for audit. So yeah, these again, for as auditors also, we need to follow these kind of risk parameters and think like a tax authority to see what are the perceived risk areas while we do the audits.
We have another question live from an anonymous attendee. Can you share more about related party domestic loan entered into on or after 1st of Jan 2025? After this change take effect on 1 Jan 2025, IRAs no longer accept interest-free related party domestic loan, even though the company meet the TP documentation exemption.
In the e-tax guide, which was the 7th edition that came, IRA said that domestic TP loans need to be benchmarked now, and they need to be justified through a proper basis if they cross those thresholds. Now, IRAS has a safe harbor that if the loan doesn't exceed 15 million, you can apply the interest rate prescribed by IRAS. But again, if you want to follow a different rate of interest, benchmarking can be undertaken to determine the interest rate. Earlier, the provisions were a bit different, but now they have brought it at par with the overseas loans, and they say that a benchmarking is required. They will no longer be considered at arm's length if it is interest-free. unless and until there is a basis that it is a startup kind of a situation, or it is a situation where the funding is required for some specific short duration, such that the entity which is borrowing the money doesn't have the capability to pay interest at all. Those are unique circumstances which can be documented to justify that it is interest free. But in no other circumstances, yeah, the IRS expects that it carries a return for the lender, and the lender, when lending money, is expected to get a return on the funds that have been lent out.
Again, you can type in your questions in the Q&A icon at the bottom of your screen. While we are waiting again, I can have one more question from the submitted questions before. Can you share practical steps companies can take to mitigate transfer pricing risks and strengthen their audit readiness?
Companies in this case should have a robust and contemporaneous documentation, including the functional and risk analysis, benchmarking studies. Again, these are documents which will ensure that the related party arrangements are justified and are covered by a proper analysis. Again, it's important to have the related party contracts in place, which will give or which will show out the clear substance of the transaction. And again, the actual conduct matters. So whatever is carried in the interco agreement and the actual conduct of the parties have to be in sync to ensure that the actual conduct and the substance are governing the related party transaction.
How do authorities typically approach transfer pricing audits, and what are the consequences of non-compliance for companies?
So tax authorities will start the process. They'll assess the high-risk taxpayers, high-risk transactions, and then send out the first notice to ask for TP documentation and ask few questions regarding the related party arrangement. Once the documents are assessed, there'll be more specific questions coming in for related party arrangements. Like I've come across situations of management fee where the pricing markups applied, benefit test, nature of services, interco agreements. If the tax authorities are generally satisfied with this, they'll close. Otherwise, they'll ask for more detailed information. And if in the end it is proven that there is no basis, there is no justification, tax authorities will do the calculations at their end and do the TP adjustments and send out notices, final calculation, and then the application of 5% surcharge also comes into play. Now, at this point, I just want to point out one thing, that after TP adjustment, there may be a situation that there is tax payable or no tax payable because of brought forward losses. But that 5% surcharge is still applicable on the TP adjustment amount, which has to be paid by the entity who has faced this adjustment.
Okay, we have another question from the live audience. Further question, which mean the company must prepare a TP benchmarking analysis if they do not wish to use the indicative margin published by IRAS?
Yes, I think this is for the interco loan. That indicative margin is given by IRAS. That's a bit on a higher side, but based on the interco arrangement, based on, say, generally what we do is we do a tentative credit rating for this loan transaction based on the FS. If we perceive that the default risk is less, or if the perceived risk as far as the interest payout concerned is very low, then we can do a benchmarking analysis and come up with a lower rate of interest, because then that is justified through the risk analysis, which is perceived default risk or any other repayment risk that occurs in these loan transactions. So that benchmarking will be sufficient or will be as an evidence to the tax authorities for applying a lower rate of interest.
I think that ends our Q&A portion. So as we close off today's webinar, we'd like to thank all of you for joining us today and for all of your questions. As mentioned earlier, we will share the recording with all the registered attendees in due course. We hope everyone has benefited from this webinar session today. And once again, thank you very much.